What's up, guys? I hope you're doing well. James here again from jamesdforsythe.com. Last night we went over like possible benefits and such for central bank digital currency, at least from the Federal Reserve's perspective, when that currency is their liability. But I will give credit where credit is due in this paper that their publication, Money and Payments. It's also they also go over some risks that come along with it and some policy considerations that they have to have if this were to be implemented. So that being said, we will head right over to the screen share. Go over there, and then I will make it bigger so you guys can see it. Okay, so possible risks and such for such a currency. If I could scroll. So basically right now, right? So banks currently rely in large part on deposits to fund their loans, and a widely available CBDC would serve as a close or in the case of an interest-bearing CBDC near perfect substitute for commercial bank money, right? And so again, commercial bank money are liabilities of the of the commercial banks themselves. These are your bank deposits and stuff. The money that you hold in a bank account is a liability of your bank, right? And this is in contrast to what a CBDC would be, a central bank digital currency, which would be a liability of the Federal Reserve, right? Central bank money. So this substitution effect would reduce the aggregate amount of deposits in the banking system, which could in turn increase bank funding expenses and reduce credit availability or raise credit costs for households and businesses. Essentially, basically, snuffing out a commercial bank's ability to give out loans. Whoops. Sorry about that. There we are. Okay. So basically, the argument is with a central bank digital currency, it would be kind of, I guess, a competitor. I don't know if that's the perfect word for it, but it kind of gets the idea across. It would compete for the dollars of individuals and businesses, right? Especially since, like in last night's video, we talked about how the idea is to have the commercial banks themselves be intermediaries of this, and other non-bank financial institutions as well. So yeah, and so this kind of substitution, as I say, would be taking deposits away from commercial banks when individuals would prefer to have the central bank digital currency over a commercial bank deposit, right? Basically having your dollars be a liability of the Fed rather than a liability of a commercial bank, whatever your bank is, right? And then similarly, to continue on, an interest-bearing CBDC could result in a shift away from other low-risk assets such as shares in money market funds, treasury bills, and other short-term instruments. A shift away from these other low-risk assets could reduce credit availability or raise credit costs for businesses and governments. Again, treasury bills and other kind of similar short-term instruments, as to use their language, a lot of the times these are used as collateral for loans, right? Maybe not necessarily like if you were to go to the bank with a mortgage or for a mortgage, the house would be collateral, right? Well, when a bank loans to another bank, a lot of the times they will use some form of security as collateral. Like the pristine version, at least as of right now, is short-term treasuries. They can also use corporate debt. They can also use mortgage-backed securities, and various other things. But just to give an example, right? So basically, if you had having an interest-bearing central bank digital currency would kind of introduce another competitor into this market for these funds. So Other point, a non-interest bearing CBDC, for example, would be less attractive as a substitute for commercial bank money because it doesn't gain interest. In addition, a central bank might limit the amount of CBDC an end user could hold. And I kind of alluded to this in previous videos, and I just wanted to I highlighted this in blue to make it obvious that it's like, that's not me saying it, that's the Federal Reserve saying it, saying like, hey, they might limit the amount you could have. Now, again, this would just be, at least as of right now, it seems that it would just be a competitor to commercial deposits. So you have to keep in mind, it's like, people think of dollars as like its own thing, right? And so when you're dealing with this, especially one of the major concepts that learning about a central bank digital currency, or just kind of specifically central bank digital currencies, but kind of currencies in general, it's not so much that you have dollars, right? It's you have some asset denominated in dollars, right? The US dollar is just a unit of measurement. It's like inches or miles or whatever. um Pounds, uh as another example. And so basically you're having this to where um there's different things that could be used for money, like how big commercial banks, like we were saying, when they do interbank loans, so a bank loans to another bank, they're not giving them cash, really. They're not going to like transport physical cash, most likely. They're going to do like use the treasuries or some other form of money, to where, like, for an example, treasuries can be used as a form of money for like banks and other financial institutions, because it's one of those kind of, what are we defining, like, what the US dollar is just debt, right? If you've noticed, when we were defining the different types of money and such, where everything's a liability of someone else, it's a debt. So that's all it is. And so a treasury is just a debt of the federal government, and so it's used as money for whatever purposes. And that's kind of the point I want to get across, is that the dollars aren't just like green pieces of paper. They're liabilities, right? It's just those green pieces of paper in your wallet happen to be um, the only form of quote unquote of currency, we'll say, that individuals can hold that is a liability of the Federal Reserve, right? Um, that's why it has printed on it Federal Reserve note. It's a debt of the Federal Reserve. Um, Anyways, to continue on, um, so the ability to quickly convert other forms of money, including deposits at commercial banks, into a CBDC, could make runs on financial firms more likely or more severe. Traditional measures such as prudential supervision, government deposit insurance, and access to central bank liquidity may be insufficient to stave off large outflows of commercial bank deposits into CBDC in the event of a financial panic. So I guess it's kind of the same idea of what foreign countries do in like global panics, financial panics, to where they kind of flight to the US dollar, or at least they have been for my understanding the past few, like, recent decades, right? Um, and you can kind of extrapolate that back all the way to Bretton Woods, I believe. Um, so basically saying the same concept, to where if you have a financial panic, people are going to go to what they deem to be the least risky, which they're arguing is a central bank digital currency. Which I can see from a liquidity standpoint, it makes sense, because they're the central bank, they can just create it. They don't have to have any form of reservable assets, like commercial banks do. But I'm not entirely sure on how much that changes now that the reserve requirement is zero and has been since early 2020. I don't know. So we will continue. So, for example, a central bank could pay no interest on a CBDC. Nonetheless, because a liability of the central bank is essentially riskless, depositors may prefer CBDC over bank deposits in a crisis, even if a CBDC has a less attractive rate of return. A central bank could potentially address this risk by limiting the total amount of CBDC an end user could hold, or it could limit the amount of CBDC an end user could accumulate over short periods. So basically, create not only preventing you from holding over a certain amount, but also preventing you from gaining it at a specific rate, right? So like however many units per day, whatever this short period is. Um, so right off the get go, there's kind of this idea. It's spun, or it's portrayed in such a way as to kind of save the banking system, right? In a way, or keep some money at least as commercial deposits, because that's the whole point, is to essentially force you to have some money in banks, right? Um, or at least on aggregate total, it would create the incentive to leave money in banks, because I think it would be hard pressed for the entire, like, all dollars to leave commercial banks and go straight to central bank liabilities, especially if there's a cap on it on a central bank digital currency. Otherwise, the only form an individual can hold is cash, besides this digital currency, if it were to come to fruition. Um, but anyways, that's just one thing to keep in mind. So policy implementation. So a CBDC's design would influence how it might affect monetary policy. Under the current ample reserves regime, monetary policy, the Federal Reserve exercises control over the level of the federal funds rate and other short-term interest rates, primarily through setting the federal funds administered rates. This regime does not require active management of the supply of reserves. This is something I've talked about a few times. I have 2 or 3 posts and videos on this specific one, on this specific stuff, specifically the ample reserve regime and what exactly it means, right? And so kind of their way of defining an ample amount of reserves is there are so many bank reserves in the system that you have, they don't need to actively manage the supply, right? Because any significant fluctuation in the amount of reserves would not influence short-term rates, right? At least to a significant degree. And that allows them to essentially control short-term interest rates just through their administered rates. So like overnight reverse repo rate and the discount window, IORB now, interest on reserve balances. It's no longer interest on excess reserves because there's no reserve requirement. And I have posts on each of those specifically as well, which I might link just to make it easier for you guys. But specifically the ample reserves one, that's one of the most popular, so to speak. That's the one I get the most views on. I don't know if it's just because it's so applicable to everything, because it's so essentially like everything monetary policy wise, it seems at this point in time, kind of, at least what I've studied and gone through, has kind of pointed back to this regime change in some form. But yeah, so I'll put that in there to make it easier. So in this framework, the introduction of CBDC would affect monetary policy implementation and interest rate control by altering the supply of reserves in the banking system. Basically, people going to the currency rather than just holding them in banks. So in this case, a decline in CBDC would result in a corresponding increase in reserve, would only make reserves more ample and would have little effect on Fed funds. Similarly, an increase in the CBDC would push reserves lower, would also have little effect on the Fed funds rate if the initial supply of reserves were large enough to provide an adequate buffer. And this is where it's kind of interesting, and I talk about it a little bit more in depth in some of the posts. Kind of this whole buffer, right, between okay, what exactly is the definition of an ample amount of reserves? And we kind of found it in late 2019, I believe September or October. I don't remember off the top of my head, but in the post, I have the charts and stuff as well from the Federal Reserve Bank of St. Louis, the Fred charts, going over the amount of bank reserves and stuff like that when that repo spike happened, and stuff in 2019. And so basically, they would have, or the banks would have, the option between the bank reserves or the central bank digital currency, right? And so that's kind of the whole, like, if everyone's switching, or if they're switching over to the digital currency, the central bank digital currency, the bank reserves would go down. But again, I'm not entirely sure how that would change with respect to commercial banks, because essentially bank reserves are kind of already a central bank digital currency from the perspective of a commercial bank, it seems, because they're central bank liabilities in digital form, right? um so I don't know, there's a lot more nuance into that one would initially believe, I think. And part of that's because with bank reserves, you have like a certain amount, like different reservable. Uh, there's something called reservable assets, to where it like depends on the type of assets on how many reserves you need to back it. Um, I don't know. That's kind of getting into more of an area that I am less familiar with the nuances of it. Um, from my understanding, it has to deal with, I wrote down some of the ideas and stuff. So, like the SLR, the supplemental leverage ratio, and there's a few other ratios and stuff that aren't coming to mind right now, that I believe apply to this specifically. But I haven't done any in depth research on them specifically yet. And so those will come in the future as well. Um, I typically, for the blog posts, on the more technical stuff, when I dive into the nuances, I start with writing the blog posts so that I can, especially with the writing, it really helps me kind of formulate and understand it. And then I do the video on it. Whereas when it's this stuff, the whole point is to just kind of get it out there, think through it. You guys can watch me thinking through it as I'm trying to explain it and such. When it's much more technical language and kind of concepts, it's just a lot easier for me to write. Otherwise, I think it'd just be kind of a waste of your guys' time to sit here, because I'd literally just be sitting here like this for God knows how long, trying to think it through, and then literally drawing pictures on post-it notes and stuff. I think you already threw them away, but I literally put like draw balance sheets on post-it notes and be like, hey, money here goes there, and so on. That's how I did reverse repo. I think I actually made a specific post about that with reverse repo, to where it was literally like I made my own like little balance sheets and was like, hey, bank reserves go here to here. Okay, their transactions open. Then I was like, hey, close the transaction now here to here, and showing the swaps and stuff and explaining what can kind of happen, because I was really trying to get a deeper understanding of what's happening at each kind of segment of a repo. But anyways, to continuing on, not going down any further rabbit holes. I already said that part. Sorry, that's why I need to stop doing so many rabbit holes, because I'll just completely forget what I was doing. But to continue, additionally, the Federal Reserve would likely need to increase the level of reserves on average, because they need even more apparently, in order to provide a adequate buffer against unanticipated increases in CBDC. Such surges would otherwise push the aggregate quantity of reserves in the banking system below the ample level, and put upward pressure on Fed funds. Okay. So I made a comment here. So again, reverse repo in 2019. So that's pretty much what happened. Was the amount of bank reserves went below ample amounts, or at least that's what it was deemed from one of the studies done by the Federal Reserve. I forget the name, and that's something I probably would have linked to in that video, or not in the video, in the post when I did it, because my data and stuff that I do when I do those posts comes from like the staff reports and other like published data on there, and I always link it so you guys can find it as well and use it. But yeah, that's all on that one. So the interactions between CBDC and monetary policy implementation would be more pronounced and more complicated if the CBDC were interest bearing at levels that are comparable to rates of return on other savings assets. Sorry. So basically just adding another competitive investment for whoever would be buying it. The potential for significant foreign demand for CBDC in this scenario would further complicate monetary policy implementation, as it seems to me that would basically be competition for treasuries, which would be very, very not good. For that would be very bad from a monetary standpoint, because that seems like that's the whole name of the game, is the U.S. government debt. The more you kind of look into it, it seems, at least. Yeah. Going on more of the, I guess, more potential risks, consumer privacy. So kind of transitioning from the whole monetary policy implementation of it and going into the actual risks that come along with this. Having a general purpose digital currency that's a liability of the central bank would basically would be a hacker's gold mine, so to speak. And so to have the amount of digital infrastructure for that would need to be massive, right? Because you're essentially having, instead of having the entire nation's finances on multiple different balance sheets across like all commercial banks and credit unions and so on, you're essentially congregating them all on the feds. And so I don't know. I don't know the nuances in that would arise, at least, because they're also talking about it being intermediated by the commercial banks. And again, this is just an initial paper. This is nothing like this is what we're doing or whatever. It's just kind of a proposal and them themselves thinking through it, giving risk, benefits, so on, possible ideas. So kind of the nuances and like how that intermediation kind of relationship would work, who knows? I don't remember seeing anything with that specifically in this paper. Prevention of financial crime, yeah, always you got to deal with that. Money laundering is pretty much the go-to excuse, it seems, for more regulation. Operational resilience and cybersecurity. So I already kind of touched on that. So basically making the system resilient and resilient from hackers as well. So threats to existing payment services, including operational disruptions and cybersecurity risks, would allow a CBDC as well, would apply to a CBDC as well. Any dedicated infrastructure for a CBDC would need to be extremely resilient in such threats, and the operators of the CBDC infrastructure would need to remain vigilant as bad actors employ ever more sophisticated methods and tactics. Central banks are currently researching whether offline CBDC payment options would be feasible. And so one of the things that we just haven't gone to in this paper specifically yet, is because it's later. I'll go ahead and stop the screen share. Is the whole fact that, they're still actively researching all this. I think at some point they even talk about like the different boards they have set up, and to where it's going to be like who they're dealing with. Like one's dealing with MIT, one's dealing with I don't remember. There's various other things that they're doing. And they're basically just talking about how stop. Sorry. I'm on a laptop, so there we go. But yeah, they're still actively researching like all of this. And this is simply just a proposal paper, which means as more publications and such come out, I'll make videos on those too, just kind of going over who knows what they're thinking, I guess. Because even some of the minutes, Fed minutes and stuff, don't make sense. But anyways, I'm gonna leave it there. So yeah, I hope you guys have a good night, and I will see you on the next one.